So the stock market's just tanked. Trump's tariffs are causing global tension. And what does this mean for your property portfolio? And more broadly, what does this mean for the Australian property market? We're going to break down what is happening and what it means for property investors, and whether property is still a safe investment in 2025. Now, before we get into it, I'm not proclaiming to be an expert here. I'm a guy who's just bought a bunch of properties and spent a almost 20-year career in Australia's bank, working with Australia's largest banks, I should say. But I'm not an economist. I don't proclaim to be some kind of property guru, expert, or anything like that. I'm just sharing my opinion based on what I've seen over now a few decades being in and around property. So obviously we've just seen the ASX has just lost 100 billion, which is the biggest drop we have seen since COVID. Obviously, the thing with Trump causing a bit of global tension, there's a bit of GFC jitters going around, and that's part and parcel of how these things go. Markets move in a cyclical nature. There is a peak, there is a trough. These things happen across every single market all of the time, really. So what does this actually mean? Now, I think before I get into the detail, it's important to understand, particularly with property is what I know best, is there is going to be blips in the radar through the property journey that we have. Now, generally, as investors, most of the wealth that we tend to build is built up over an extended period of time. Along that time, there is going to be market fluctuations. But if we are too focused on these little blips in the radar, we tend to miss the bigger picture. And the reason I say that is there's quite a few people now that are perhaps sitting on the fence waiting for the outcome of what's happening in the global economy to do its thing, and I feel that you're kind of missing the point in that if you're waiting for something to happen or something to not happen, you're actually just going to miss out. And I'm going to share with you some examples of what's happened historically in the 2008 GFC. In the Black Monday crash in the 80s. I'll show you some examples of what's happened in the Australian property market back then, so we can have a rough indication of what may happen now. Now, that doesn't say that's going to happen the same way, but it's a pretty good indicator, history is. So let's just go back to where things are right now and bringing it back home for us, in that the RBA at the moment is likely to be cutting rates further. Now, we've seen New Zealand has just dropped rates further. There's lots of rate cuts on the cards for other countries around the world. Now, if you have a look at the 30-day interbank cash rate futures, which I'm bringing it up on my phone so I can talk to it, but we're going to flash it up on the screen. Now, this is basically what the market is pricing in for rate cuts as we go through. Now, as you can see at the moment, the rate is sitting at, and this is the cash rate, just sitting at 4.1%. As we move through each month of this year, you can see there's significant rate cuts priced in all the way through to actually November this year. They're expecting the rates at this point in time to go as low as just a little under 2.8%. That's the cash rate. Now, obviously, this can change. This can go back up. This can also come further back down. But this just gives you an indication of what the market sentiment is at the moment. Now, imagine if, excuse me, one second. That's a sneeze. Now, imagine as a property investor, rates come back down to 2.8%. That would mean you'd have a retail rate of about 4.5%, which is about 2% lower than what most investors are paying right now. This is very interesting for me as a property investor. Now let's kind of break this down. So you've had a stock market crash. You've not had a property market crash yet. What I would believe is that investors in the stock market could potentially be looking to exit that volatile market and move some of their money into a much more safer investment, being Australian property, and I'll show you why I believe it is a safer investment than the stock market. Now, you take money out of the stock market, you put it into property, rates come back down, more people that were actually looking to buy, firstly, they can borrow more, and secondly, if you've already got a portfolio, you're potentially, and you're maxed out, maybe the rates come back down 2%, you're going to unlock more borrowing power and you're going to be looking to go again. Because I know a ton of investors that are maxed out, and they have been for a little while now as rates have gone up, and they're just chomping at the bit to have rate cuts so they can get back into the market. What is that going to do to the property market, right? We've already got a very tight supply across most of the country. You unlock more borrowing power and more people looking to buy. That is only going to push up prices in certain markets. That is my opinion. That doesn't mean, again, I'm not proclaiming to be some economic expert, but that is just my opinion, right? Based on what I have seen previously. Now, let's get into what I have seen historically, which is helping me form the opinion that I have that the property market's not really going to take too much of a hit. Now, let's have a look at the Black Monday crash of 1987. Now, this is quite a long time ago, but the stock crash, the stock market crash, didn't hit Australian property prices at all. In fact, the property prices surged after the stock market crash in 1987. Now we'll look at the GFC in 2008, but the property markets fell roughly 7.5%, and that was mostly due to a tighter credit supply and a lot of uncertainty. Now, we can take those two events and trace them, sort of template over with what's happening today. And we don't necessarily have tight credit because rates are looking to come back down, but we do have that uncertainty, particularly at a global level. So what your guess is as good as mine as to what might happen. I just think looking at, being in the property market literally, daily and speaking with tons of people who are just, sweating and waiting to get into the market, I, in my opinion, think that this time around, the property market will be more resilient unless credit availability becomes tight, right? So, I don't know, maybe APRA comes out with a new, lending requirements, maybe rates don't come back down. These sorts of things will have a flow-on impact in the property market. Like I said, when equities crash, investors often turn to bricks and mortar. They often want to, hey, I've just lost a ton of cash in this. Let me go and invest my money in something that I can actually touch and feel. This is just a psychological thing that happens. Not everybody, but obviously, generally speaking, there. And property is often seen as a safe haven. Like I've said in other videos, everyone needs a place to live. Not everyone needs to invest in a company that produces phones or is a whatever. But I think what is important, and this is something that's stuck in my head since I was a kid, hearing Warren Buffett, that when everybody is fearful, that is a time when everybody's running out of the building. That's when you want to run into the building as it relates to market sentiment, market crashes and things like that. Because as everyone's panicking and sitting on the sidelines, there is going to be opportunities out there for savvy investors to pick up bargains left, right, and center. That is just how things go. So when others are fearful, I think the saying from Warren Buffett is, when others are greedy, be fearful. When others are fearful, be greedy, or something to that effect. And that's just stuck in my head, time and time again. And, that sort of contrarian mindset and going, all right, well, there's fear in the market. That's when we start to go, all right, well, there's some opportunity here for us to really capitalize and jump in. Now, we need to be careful. We need to be conscious of where we buy, what we buy. As I always say, it's not just buying any old property and wishing and hoping it goes up in value. We need to be precise with it. Like I've said in my April property market update, we're not in for a boom time just yet. We might even have a couple of markets come back down in value. What is that? What does that mean? For investors that want to buy, it's great. Prices come back down. Beautiful. Let's jump in and let's get into it. The worst case, prices don't come back down and, our money continues to grow as and when we buy. So what we need to watch is the RBA announcements as they come up. So more rate cuts, that is going to mean more firepower for buyers out there in the market, and that is eventually going to be pushing up prices. Now, if consumer confidence trends in different directions. We need to be watching this. So will people sit tight or will people start to make moves? My bet is that the smart money is going to start making moves, getting their lending sorted. So as and when they can, have approvals and things, they are ready to go. The smart money is not sitting on the sidelines waiting for things to happen, in my opinion. Now, if banks tighten up lending, that could shift the game entirely like we saw in 2008. I don't believe that is going to be the case at this time around, but we need to be looking at those sorts of things. Now, where to buy, what to buy? Like I always say, look for markets that show strong fundamentals. And what do I mean by strong fundamentals? It's got a proven track record for growth, number one. It's got strong population growth. Now, it doesn't mean to say that it's got to have, millions of people or tens of thousands of people moving into the market, but it's got to have some signs of, hey, there's people consistently moving here for particular reasons. Mostly it's going to be jobs that are driving people into a particular area. It could be, infrastructure projects happening. There could be a whole host of things, but we want to look at fundamentals like historical growth, population movements, unemployment rates, obviously things like infrastructure projects and, all the peripheral things that go along with that. But stick with the strong fundamentals. Don't buy into hype. Like you see these like Facebook groups and stuff where people sort of, promote certain areas and whatnot. Pay attention to it, but don't buy into it, is all I would say. So look, my final thoughts here is that, we're not in for a property market crash. Conditions may change quickly and therefore, my opinion on that can change quickly. But as of right now, I do not believe that the property market the bubble is about to burst. Now, I'm not saying that property isn't immune from a crash. I'm not saying that property isn't, vulnerable to, market fluctuations, but it's proven to be resilient. Particularly the Australian property market has proven to be resilient over decades, right? This is not just a recent thing. If you buy smart, all right? So buying in areas, like I said, with the strong fundamentals, you will tend to do okay. So this is a time where we need to stay informed. We need to think long-term, and use moments like this to level up your portfolio.